I guess I'll get started. Some people might still need to join, but we can just start kicking off this webinar. I'll maybe just introduce myself. I'm Carla, and I'm a growth marketing manager here at Briink. Of course, before getting started, I just wanted to say welcome to our speakers for this webinar. And they will be, as I said, diving into this topic in a bit more detail in just a few minutes. But before that, I just wanted to do a little introductions round, starting maybe from Geordie from Qualitas Energy. Hi, Geordie.
Yeah, how you doing?
Very well. Do you want to say a few words about yourself and also about Qualitas Energy?
Of course. So I am ESG Vice President at Qualitas Energy. We are a private equity renewable energy infrastructure fund. Our latest fund, Fund 5, is an Article 9 fund under SFDR. And the other funds are all focused on renewable energy as well. We are predominantly based in Europe, and we have a new office in Chile, but the technologies we are most strong in are solar, wind, energy storage, biomethane, biogas, and also hydro.
Great. Thanks a lot, Geordie. And then next up, we have Kelsea from D2L. So Kelsea, you're welcome to say a few words about yourself too.
Thanks. Hi, everyone. My name is Kelsea Walsh. I am the Sustainability Manager at D2L. We're a learning management system based in Canada, but with customers and offices all over the world. We have about 16 million users logging onto our platforms every day. And we started our ESG program about a year ago now. And so we're in the first year of major data collection, reporting, and compliance activities with regards to ESG.
And of course, I will now hand it over to Ben, that some of you might already know from past webinars, but Ben, the floor is yours.
Great. Thank you, Carla. My name is Ben Howard Cooper. I'm the head of sustainable finance at Briink. We are a Berlin-based startup building AI native technologies to support ESG analytical workflows in the context of regulation, as well as general ESG data management. So I think with that, we can go on.
Cool. Perfect. And before going on, I actually have a little sneak peek at the agenda for today. So we will go through three main broader topics, the why, the what, and the how of ESG data collections. So why you should actually make an effort to strive to collect better ESG data, why that is important and relevant, whatever your industry and your organization. And also a bit of more information about which data you should actually choose when performing this data collection exercise for ESG specifically. There are many data that you can collect in ESG, but I think we will zoom in into some key data that you need to collect during this webinar. And then, of course, we will dive into the how. So actually some practical strategies and tips that you can start implementing to improve and streamline the whole data collection process. And of course, with Briink, we will bring a bit of the tech AI perspective. So how you can embed intelligent tools, artificial intelligence, basically in your systems to sort of streamline some of the most time-consuming parts of this. And now I will just stop sharing and hand it over to you, Ben.
Great. Thank you, Carla. And thank you again to everyone for attending today's webinar. Today's session is really intended for practitioners. So we will stay away from talking around theory and really use live case studies to examine the who, what, where, when, and why of ESG data. This is a global webinar. We have participants coming from around the world. And so while we will touch on the regulatory drivers of collection of ESG data and reporting, we are going to talk more just around strategy for ESG data, why it's collected, how it's collected, who it's collected by, when it's collected. I think all of these matters are evolving over time, driven in part by regulatory pressure, but also just wider market interest in non-financial information. By the end of today's webinar, so in the next 45 minutes or so, hopefully you'll walk away with a better sense of best practices for managing this type of information, and we'll walk away with some tips and tricks for doing this in the most effective way possible. We know ESG data can be a major drain on organizational resources, So today's session is really meant to empower all of you to understand how to use this type of data to improve your organizational well-being. With that, let's just jump right into the core of today, which is the conversation we'll be having with Geordie and Kelsea. So I'd like to start with Kelsea and maybe a question, given the context of being a corporate player. What is the most painful part of ESG data collection, and where do you think it's the hardest to pull this type of data?
Thanks, Ben. I think so. First of all, how do we choose what to prioritize? We're lucky that there's a lot of regulation coming out finally around the world. I say finally because I've been in this space for a lot of years now, and it really feels like we're at a turning point. And we have frameworks, right? So we have standards, Global Reporting Initiative, Sustainability Accounting Standards Board. So from D2L's perspective, we are a Canadian company. We don't have regulation currently in Canada requiring our reporting standards, but we do have customers all over the world, particularly in Europe, which are now starting to report against the ESRS. And so part of our regulatory compliance strategy is not only to ensure that we're in compliance for our own purposes, but that we are reporting on the right data for our customers' purposes, because they need our data as well. And so we have sort of developed a gradual response, and that is using Global Reporting Initiative and Sustainability Accounting Standards Board in the first year, because that provides both breadth and depth. SASB uses an investor-focused, kind of risk-focused framework, of course, and it's industry-specific, but GRI gives us that broader scope of metrics. And so by using those, we cover our bases more broadly, knowing that ISSB just came out a month ago, and not having been sure just yet what was going to be in the ISSB, that prepared us well. And so we're looking at those two frameworks. We're also aware that GRI and SASB don't cover climate-related impacts on a business or their activities as in-depth as TCFD does, Task Force on Climate-Related Finance, which is also reflected in the ISSB IFRS S2. And so this is really a gradual process of keeping those regulatory requirements in mind, knowing that we are not privy to those just yet, but our customers are, and then using those frameworks as gradual stepping stones to increase our capabilities. That's the first part of your question. The second part, what data is most difficult to collect? The broad answer is most of it, because this is the first time that we're collecting a lot of this data. And so there's a lot of education, awareness, a lot of fear around what happens when we publish this data. What happens if there's an error in the data and we have to correct that in the following year? What if the methodology changes and that's not seen in our reporting? What if it's in the smaller font and people miss that the methodology changed, so it looks like our data changed? That's sort of the broad aspect of difficult to pull data. Very specifically, and I'll just touch on this for a second because I said I wasn't going to, but I think it's really important to talk about this. Scope 3 emissions are, in my opinion, ridiculous. We are using so many different kinds of methodology to measure Scope 3 emissions, to find this data. There are capacity issues, there are scope and boundary issues. Using spend-based data to measure the impacts of a t-shirt that came from Indonesia but is worn for 2 weeks in Canada and then disposed of somewhere in the States. Like, how can we actually measure the carbon emissions related to that t-shirt based on how much it cost, for example? And I think it's really important as we move forward that we think about these things, and that we're really scrutinizing, is this data actually useful to us? Because the purpose of data is action. And if we're collecting data and calculating data and measuring data that we can't clearly link back to the action we're taking to solve for the issues that we're working on, then what is the point of them? And so I think that is the biggest challenge with data collection, is applying that scrutiny to it and making sure that we are clearly communicating with our investigators, our investors, which sometimes feel like investigators, to collect this data and publish it properly.
Cool. Well, I think that's a really good transition over to our own investigator on this webinar, who is doing this work on a daily basis. I'm sure he feels like an investor, and I think you brought some spiciness to this webinar, which is a rare thing to have in ESG land. So I'm really interested to deep dive into your point around skepticism around Scope 3 emissions, and want to turn it over to Geordie. And what is your perspective on GHG emissions calculations? Do you use them? Do you have another way to think or contextualize them?
I think you have to use them because it's the reporting standard, and it is, as everybody said, we make data-driven decisions, right? And so you have to look at the data. I think what that data is showing and the accuracy of that data is certainly questionable, and we're completely right to question it. I mean, if you think of any evolution of any industry and technology, or anything really, like, you have to take continuous feedback on exactly what you're trying to measure. And ESG and reporting and all these methodologies are fledgling industries. And so we have to do it, and we have to do it as accurate as possible. But as we continue to report, I do think that cost-based emissions should be left at the beginning of this industry, and that is only sort of going to be able to happen as more people continue to report, more regulations come into place, methodologies are unified, and you're not seeing different reporting standards in different jurisdictions and reporting methodologies in different jurisdictions. And as you start to unify the reporting industry and the regulatory side of things, you should start to see quality of data improve and less gaps, because it's also a chain. So whatever one person's reporting, the other person is relying on that data, and so you can have quite a wide spectrum of accuracy by the time you actually get to the end of the end user or the end reporting. And so for us as an investor, we have a majority shareholder, majority share of our portfolio companies. So we are able to direct responsibility for how they are reporting and also what they report on. Obviously, as Fund 5 is Article 9, that gives us under SFDR, and we use the EU taxonomy as the way to sort of achieve that and classify that. I think that's a better way of doing it, because it gives certain criteria and it's clearer, whereas some of the SFDR, sustainable investment, I think it's Article 217, is quite subjective. So I think the clearer the regulation is, the further we get along this journey, and also, as Kelsea rightly said, the better the education and information within companies, within the industry, the better the reporting will be. But obviously, in the short term, that's not necessarily an option. So we have to continue to work with what we've got, and we have to continue to take feedback. And I think it's up to investors and companies themselves to hold each other to account. For example, if we're currently using cost-based 1 year, you have to sort of say, right, for next year as a point of progression, certainly in the taxonomy and SFDR, we're going to start using product-specific data, or where possible, and then start to make inroads on that basis.
I think really interesting insights on how investors think about this data, and I think most importantly on how you engage with portfolio assets to get this data. Maybe circling back to something Kelsea brought up at the start of her conversation, you have a unique perspective as a North American domiciled corporate, sort of outside of the regulatory pressures. They're coming, you're starting to get them on the margins. But I'm curious, who is asking you for ESG data outside of regulation? And I think double clicking on that a bit, you mentioned a really important part of ESG data. There's sort of the risk side and there's the opportunity side. Do you have a sense that your stakeholders are more concerned about the ESG risks that you're facing, or perhaps the impact and opportunity that your business can bring?
Both good questions. I think so. First of all, who's asking for our data? Investors, but mostly customers. And an exciting development that I've seen in the last year is we're getting surveys now from our customers, which ask specifically not just for our own data and but also like the responsibility that our customers have related to our data and the impact of D2L. And so they want to know what % of our business we're doing with them so that they can appropriately calculate their scope 3 emissions and other data points, but primarily emissions. And so that touches back on the point of how important it is to support the development of this industry. And that is, even though the methodology is not perfect yet, it is important to be contributing back. And then your second question, remind me, is it whether it was risk-based or opportunity-based?
Yep.
So I think this is potentially specific to the industry. I think if we were a mining company, it would be a lot more risk-based. But as an industry based in software with a lot of suppliers, we don't have our own data centers, for example. It really is about opportunity and what it's sort of that digital policy is sustainability policy aspect. What can we do as a software company to support climate action in Canada and abroad, whether that's limiting paper use because we're using a learning management system instead of kind of old school ways of learning, or whether it's using at-home learning in place of commuting to campuses and that kind of thing. So from our perspective, it really is a climate opportunity rather than a climate risk. But I also recognize that that's industry specific.
Well, maybe Geordie, what's your view? Do you think about ESG data more from the risk side or the opportunity side?
I'm going to sit on the fence. Both. So it depends what you're looking at. I mean, there's no doubt about it. If you look at ESG value creation, it's actually a massive opportunity for most, if not all, companies. And if you look at some of the data around that, and look at some of the higher valued or rated companies on EcoVadis, the sustainability rating software, if you have the top 75% or top quartile have a sort of a massive EBITDA hit increase on the sort of the other and the lower ratings. So from an earnings perspective, there's a huge opportunity. And as Kelsea rightly says, customers and society are demanding information and want, for the vast majority, want to know where their items are coming from and how your business is run. The risks are for a renewable energy company also pretty large, especially when you're sort of you're working so closely with the regulations such as Article 9. You will likely be under more scrutiny, but also you're only as good as your suppliers, really, in certain technologies. And obviously with the technologies we work in, whilst looking at those supplier reports, they're making huge inroads into reducing their emissions and decarbonization strategies. But this is a long journey, and the key word is transition. And so you can't simply decarbonize the whole supply chain with it like a click of a finger. So we have to work really closely and collaborate with our suppliers and make those not demands is probably the wrong word, but that's probably the right word. Make those demands clearer, and so they're aware of what's going on outside of their jurisdiction. And I think that is how, as the sort of a global economy, you have to sort of collaborate and across the various aspects of the value chain. So there's huge opportunity and a huge upside, but also you have to manage your risks, and reputational risk is something that's managed along the whole value chain, not just at the end, and you have to along the whole process.
Cool. No, I want to dive a little bit deeper into something you just brought up. You mentioned Article 9 and the SFDR and the regulatory pressures that come from reporting there, but I think I heard a lot more passion for the ESG data that helps you make better decisions and helps you communicate. I'm curious, how do you balance the collection of regulatory data versus non-regulatory data? Sort of what comes first in your mind? Do you think of them as sort of being part and parcel? Walk us through how you think about balancing those two elements.
It's such a great question. I think you have to, whether you've signed up for the regulation or you're thinking about signing up for the regulation, I think you have to look at regulatory data first and what those reporting standards are and what other people are reporting. For us, we have to look at regulation first. And then, because there's no point reporting on some sort of data points that are completely out of line with the reporting standards or your market. So when you look at that, we have to look at the regulation first, and then come the discretionary stuff. And our Fund 5 is sort of still at the sort of beginning of its journey of deploying capital. So what we have to also look at is the life cycle of those investments. This is not just an initial deployment of capital side of things on the regulation. It's around the whole life cycle of that asset, and we're looking at the end of life, the cycle of turbines, and what we can do there. It's not just sort of the beginning. So the regulation is pretty clear around that. The taxonomy specifically is pretty clear around that. So we have to do no significant harm in the wording of the taxonomy around those objectives, and that's exactly what we're going to be doing. On top of that, you can get investor requests and investor sort of knowledge around certain jurisdictions and say, okay, well, the regulation is not necessarily up to that standard, so what are you going to do? And that's when the discretionary stuff comes in, and you have to understand that jurisdiction, and you have to understand that local area before you start trying to implement the data points and data frameworks that will not be relevant, because there's no point setting data frameworks that you're going to report zero on the whole time, because you might as well not report anything. So you have to have data frameworks that add value, going back to your previous question, but also you're going to be able to help you be a data-driven firm and also see how you're going to hit those targets in the long run.
Mm-hmm. No, I think this concept of adding value through ESG data collection really resonates with me and the conversations I have with our clients here at Briink. I think the perception outside of sort of ESG nerd world is that ESG is a cost center. It doesn't add value. You can get this sort of skepticism around why are we just collecting data for reporting? And I think it's really incumbent upon ESG managers and firms and stakeholders across the markets to really understand, how do you take this non-financial information and leverage it to make better decisions as a corporate, as an investor, and then to use that in order to sort of improve operations within a firm. So I think that's a really critical point and can sometimes be missed by people outside of the sort of diehard ESG community. Kelsea, I think Geordie brought up an interesting point about the supply chain. And I think, he's got a very particular experience with the infrastructure world. I'm curious, how do you set expectations with suppliers? Maybe how do your customers try and set expectations with you? And how do you manage all of the communication and outreach that goes into managing all of these relationships?
That is by far one of the biggest chunks of my role, is managing communication and managing expectations with our suppliers. So from a kind of broad perspective, just in terms of D2L's development, the first thing that we did when I started was our materiality assessment. And what that allowed us to do, not only is that a building block for any ESG strategy or understanding the ESG risks that a company faces, but it also allowed us to interface with our suppliers and to clearly set the tone. We are now focusing on this, and so we expect this of you. And so that was sort of the first piece. The second piece was working with each supplier individually at first to identify the business that we have together, figure out what those data points are, making sure that we're not just a cost center. How do we look at this data, and are we going to work together to reduce the impact of the data? So, are we looking at really old systems in our offices that could be upgraded? Are we looking at additional space we're using in a data center that we don't necessarily need, for example? And then lots of follow-up. But I think the major thing that has led to success with supplier relationships and setting the tone has been consistent relationship building and understanding that we're building and working on this methodology and developing our internal systems at the same time as our suppliers. And so there's a camaraderie in that, in knowing that we're all building this together. There's a patience that has to be applied. And there's been a lot of times that I've sat on the phone for hours with suppliers and figured out methodology in their own systems to get the data that I need. And that is helpful to them too, because in a lot of cases, we are the first customer of theirs that have come to them requesting this data. And so as they get more requests, D2L then becomes the customer that supported them through the process and being able to address those requests as they accumulate. And so, yeah, a lot of communication and a lot of relationship building.
Maybe digging in on that a little bit further and really talking about the practicalities there. In the very beginning of the webinar, you mentioned this issue around evolving data, changing methodologies. Now we have this concept of complex communications with suppliers. What sort of tools do you use to manage all of this, if any?
So I know Briink is a software company, and I've got to tell you honestly, we're at the very beginning of our journey, and so we're not using software yet. But I am a prime example for a strong use case for this software, I think. And so that's part of our considerations as we're building. I think every company needs a year at least to get their systems under wraps, to understand what the challenges are, to communicate not only with senior leaders, but also the board. This is new for everybody. And there are a lot of senior leaders that have been in business for years and years and are just starting to learn about the impacts and the importance of ESG. And so all of these investments and softwares, everything, it's building the business case and understanding the use case for it, and then applying it. And so how do I manage it today? Microsoft Outlook and Microsoft Excel. But how do I hope to, manage it tomorrow is eventually software services to support all of these requests.
No, I think it's a common pain point that I hear across the market and a very common approach. You want to bootstrap it the first year to really understand how the pipes are put together and maybe go through that pain point and then sort of offshore that to somebody else so that you can focus on sort of the real value out of interpreting and managing that data. So that's certainly something that I've heard broadly. And I think it'll be interesting in the context of Europe as we move into 2024 and the second periodic reporting cycle. Sort of how people who bootstrapped it this year realize that it's just not an efficient way to move forward. Maybe thinking a little bit more about this value added concept of ESG data. For Geordie, as an investor, you're always looking to the future, right? That's how you manage investments well. But ESG data is really inherently backward looking. So how do you square that? And does it influence the type of data that you collect?
100%. So I think with anything, you have to look at the trend, but also as it's such a sort of a new area, as we've been speaking around, you also have to understand if it's a direct calculation or if it's an estimate. And then as you move through, you can we can receive data, and then if we get the raw data, we can sort of do our sort of calculations off the back of that. So on sort of various other metrics. So I think it's certainly important to understand what they're trying to report and exactly what they have reported and where that data has come from. But also you can sort of align that with maybe a methodology that you use in-house or some other data that maybe they don't have access to, and therefore really start to increase the accuracy. And also, if a company or an asset, for example, has a low ESG score but is not using that much data, there's incredible value in that asset and company itself by improving the education, improving their access to data, improving their access to software. And you may find that quite quickly those ratings or those data points that were missing can be found, and therefore that value is created relatively quickly. For example, we look at lots of different jurisdictions, and it's very important for us to understand exactly what's going in this jurisdiction. But if we look at we can't get an asset approved unless we get the right permitting and planning, and if we do an environmental sort of assessment, that has to be done, and therefore we can see what problems there are from an environmental standpoint. And so if even if it comes down to budget, I mean, it might mean that we can, some company can't afford to have that budget or haven't done it yet because they're waiting for someone like us to come and buy them and implement that strategy. So it really can depend on the company. And so you have to understand that, but also you have to improve their education and sort of put out a timeline of realistic targets as well, because there's no point setting a target that's completely out of scope, because you might as well not do it. So you have to set realistic targets off the back of that data, and I think you'll quite quickly see where that value can be created, but also understand what is being done and what can be done, because those are two very different things. I mean, some things you don't have data for and you don't necessarily have the understanding and knowledge of the industry, you may be like, okay, well, that's not necessarily important, or we're going to leave that for this year. But as soon as you sort of improve that education, improve that access to data, you will probably find that the reporting capabilities will increase quite quickly, and therefore so does the value.
Mm-hmm. You mentioned proxy data, and I'm interested to see sort of, and you mentioned different types of proxy data. What do you see as being differentiators of types of proxy data? When do you want to use proxy data? When do you say absolutely not, only company reported?
That is a very good question. And you ideally don't want to use proxy data. For example, I started with Qualitas maybe 4 months ago. So it was very much towards the end of that first reporting cycle. So we had a software provider, we had sort of emission factors, and we had the data. So we had to what I would use that period as a review period for next year. So we got as much information as possible, got all the correct information. But for some of the data points, we did use estimates. And to Kelsey's dismay, we did use cost estimates and cost-based reporting. So and that comes down to better reporting in the future. But as we go through that process, we can start to look at some of the technologies we use will have an LCA done. And also you have to ask that question, can we do an LCA? And is there technology available that offers that for next year? And so I think the main point for us is to, as a point of action, is an explanation of the sort of the PAI statements and the reporting, is to show how we're going to start to look at more product-specific emissions, and a lot more of our technologies offer that service, and certainly the wind technologies do. So therefore, it becomes more accurate. But I think you do want to avoid proxy data where possible. But for us, we're sort of in an advantageous position in the fact that our assets, whether it's renewable energy, CO2 emissions avoided, all that sort of stuff, it's primary data. So we can really sort of have a look at that and have access to that primary data. And then the supply emissions and scope 3 emissions is probably more where you're more likely to use estimates.
Yeah, no, I think those are all really accurate points, and I think it really it reflects what I hear in the market as well. I think not all proxy data is made the same. There's a difference between derived data, estimated data, modeled data, and I think one of the concerns that I hear a lot from investors is, okay, I've got this data gap. I go out with a proxy number now. I have to collect a real number in 2 or 3 years. How am I going to explain a massive change? And so, trying to find proxy data that is a real proxy and not just sort of a finger to the wind is a real challenge. And, I think there are a lot of really interesting market providers out there who are trying to crack that nut. But hopefully with all of the changes in regulatory reporting and discretionary reporting, we'll have a better pipeline and proxy data won't be needed over time. Kelsea, interesting, because I think we've been talking a lot about sort of broadly data, what type of data you collect, what are the pain points. Because you guys are sort of at the start of your ESG journey, how have you been prioritizing? These are the data points that we are going to collect. Is that a reflection of external pressure or internal mission setting, or some combination of the two?
So we started with the frameworks. and we worked off of what was available. So to Geordie's point, you build off of what's available, and then you continue to improve year over year with education, with the development of methodology. Some of the data that I received this year, I had, but I wasn't confident in the methodology. I wasn't confident in the scope or the boundary of the data. And so we couldn't publish it. And so these are all, it's all just sort of a practice in improvement, right? And so working with our suppliers, working with internal stakeholders to develop our processes, even internally, there's things like learning and development hours that are requested from Global Reporting Initiative. And that is an important social indicator of how we're supporting our employees, for example. We know how many webinars we provided and how many people attended, but we didn't have a calculation of the number of hours of learning and development that we provided to our employees. And so where a lot of these data collection pieces took hours this year, we're working on streamlining those. And so we worked off of what was available.
Okay. You touched on a point that I know has come through in the Q&A around what data points are being collected to report on the social pillar. So you touched on learning and development, which I think is a really interesting one. Were there any others that you were using as part of the social pillar?
Yeah, gender diversity, representation of ethnic and racial backgrounds in our workforce, for example. They're escaping me now. Health and safety, amount of training that we provide regarded to our code of conduct. The gender split among technical roles, non-technical roles, and management, for example. And so there are a lot of social indicators, and we could, go on all day. How many suppliers did we check for their anti-slavery policies to start with the modern slavery due diligence? Not start, that's a process we've had in place for a while at D2L, but there's a lot of incoming regulation around the world, specifically on modern slavery and due diligence, and just in the last year. And so making sure that our process is up to snuff with those pieces. But I think what is most interesting to me from a software company perspective, knowing that we're in Canada and that we're not privy to EU or other regulation just yet, is the diversity, equity, and inclusion pieces. And I think once we're measuring those in a systemic way and we're watching how that gender split and how the racial and ethnic split among our workforce is actually progressing through levels of seniority at the company, then we can start to set targets. And that's where things get really exciting in sustainability, because that is something you can action people around, and you start to build the plans and you start to really change the systems. And so that's the whole purpose of all of this data in the end anyway.
Definitely trying to make value out of data, which is, I think, the right approach. Maybe, Geordie, interested to hear your perspective as an investor on social data points.
Yeah, it's such a massive part. And actually, we can see the spotlight, if you like, has been, certain topics have become sort of more center stage. And the social side of things is certainly becoming that, exactly that. And specifically in Europe with, CSRD and the dual materiality and massive human rights side of things, it's really becoming important, and it's something that we are really focusing on. Also, we get a sort of pressure from our investors around sort of diversity as well. And we use the taxonomy as a benchmark, but also interestingly enough, there's certain laws still around in Europe that mean that you can't report on some diversity data points. And so that is a limitation for us on that. It's sort of seen as private data. So we can't report some metrics. And we sort of are pretty clear on that to our investors, is that, look, like, we would love to have all this data, we'd love to collect this, but unfortunately there's a legal requirement within the jurisdiction, some of the jurisdictions we work in, that we're not allowed to ask for that data. So that does limit us. But then within our portfolio companies and within our sort of suppliers, we're pretty firm on international standards, regulation that we need to adhere to, and therefore they need to be aware of. Also, when you look at sort of the responsible sourcing, the conflict mineral side, and the materials around some of our technologies, we're pretty firm on that as well. And so you need to make sure that you're aware of what is you're able to do in your jurisdiction, also aware of what the risks are to your technologies and to your business area. And then also you need to try and gather that data, and you need to report it. You need to be pretty clear on that. And I think, as Kelsea says, the targets around DEI and also the sort of emissions and decarbonisation is where it gets fun and where it gets really interesting, because you can actually start sort of rolling sleeves up and start making some value creation strategies.
And I think it's a critical point. This reporting of ESG data is the starting point. This is where you can really build strategy and engagement off of. I think, when people think, okay, I've reported my ESG metrics for 2022, I'm done. No. In fact, this is really where you can start to build out frameworks for engaging with problem parts within your organization, with your suppliers, with your regulators. So I think really framing ESG data collection as being the first step that then enables a organization to adapt and to sort of evolve over time, that's really critical. And I think, a observation I have is, to not think of ESG as a binary good or bad. Just because you report a high scope 2 emission does not mean that you are a bad ESG company, right? It needs to be contextualized. It needs to be viewed over time. This concept of materiality and momentum. How is this thing changing? How can I engage? That's how you have more interesting and meaningful conversations in this world, rather than just saying, oh, you hit a threshold. No way.
So, to your point on that, it's low-hanging fruit. So when you first start doing these calculations and you start doing this reporting, it becomes very clear quite quickly on where you can get initial runs on the board. And so use it as a feedback tool, not necessarily as like a shame tool. It's like, okay, well, look, this is our first year. Okay, there's pretty clear where we can start our work, and then we can start going through that progression. I think that's the mindset you have to have.
Exactly. Well, I've been selfish in asking all of the questions. I think it's time to open up the floor to our audience. Before we jump into the public Q&A, I'm going to hand things over to Carla. But in the meantime, if you have any burning questions, please feel free to start shooting those off in the Q&A, and we'll address those in just a couple minutes.
Yes, Ben, thank you. I actually see many questions coming in the Q&A section. But before that, I actually wanted to show you the results of the poll that we launched at the beginning. So let me just share those results so that we can comment and have a look together. So now also the audience should be able to see the results. So to the question, which parts of the ESG data collection process do you find the most challenging? I can see a majority of people actually pointing at collecting data across multiple departments and portfolio companies as one of the most challenging parts. But I would say, there is quite a spread in the answers. Some find deciding what data to collect very challenging. Around half of the participants also find the proxy data topic that you were mentioning before, Ben, quite important. And I think a smaller percentage, almost 1/3 of the participants finds that communicating data collection needs to other stakeholders can be a problem. And then, of course, I would be curious to know what that other 7% of other things are. So if you are one of those who answered other, you can maybe leave a question in the Q&A function regarding that. But what do you think, Ben, and also Kelsea and Geordie, of these answers?
Reflects what I see in the market. I think there's this huge question around proxy data, and a lot of that is driven by the European context, with the SFDR giving quite clear guidance, sometimes not so clear, around the use of estimates and proxy data, around this concept of best efforts in collecting data. So I think the major pain point that I hear talking to my clients is, and I think Kelsea mentioned this as well, nobody wants to be accused of greenwashing. So going out with a number that you're not fully confident in, that you can't back by explaining the methodology, is a huge risk. And so there's this difference between sort of black box proxy data, where you type in sort of your parameters and you get this number back and you don't really know where it came from, versus sort of proxy data, which is more derived in nature, which uses some company-specific inputs in order to come up with a more accurate or intelligible number. And I think really critically, being able to explain how you are getting to numbers. The best ESG reports I see are those that have huge footnotes that really go into the detail of what numbers they're reporting, why they're reporting them, how they're reporting them, because then you always have something to point to when somebody says, oh, you said that you're doing this sustainably, but we found this point. You can say, well, look, this is the way we're reporting it. There's a lot of gray area in the way these metrics are managed. Here's our viewpoint. Here's why it's our viewpoint. And I think that that helps sort of defang any claims against greenwashing.
And to build off of that, Ben, I think those massive footnotes are critically important because that's also what allows investors and customers to be comparing companies, right? If I think about scope 3 emissions, even presenting to the board and senior leadership to say, here's what our competitors are doing. I have to preface that every single time by saying, one of our competitors, all of their offices are in Australia where they run on coal. And so, of course, their scope 2 emissions are going to be higher than ours. Or their scope 3 emissions are lower than ours because they only used 1 or 2 different categories rather than a more broad inventory. And so being really clear about that methodology has so many different uses, communicating across senior leadership and understanding how you measure up to competitors as well.
Great. If there are no other points on this, I would actually move on to answer some of the questions that have come in. And I think some of these are actually very much related to what you were discussing. So maybe I would start from one of the questions that seemed the most broad. One of the participants was asking if you could actually provide sort of a broader background on ESG, because there are some people in the audience who are not maybe familiar with the term ESG itself and would like to understand, okay, in concrete, what does this actually mean? So I would actually hand the question over to Ben, maybe, who can, I don't know if you want to take that on.
Well, I have to say you're a very brave webinar participant for jumping into ESG world on the data side. This is probably one of the more complex areas to think about rather than just the general frameworking that is associated with ESG. Look, I'm going to take it simple because it was a simple question. ESG is a framework through which you can use to assess risks and opportunities. It is a set of data points and frameworks that help you understand how a company or an investor might face risks and how they impact their shared environment. ESG is the set of data points and common data points which we use to communicate around this in a standardized way. So rather than everyone sort of reporting their own environmental, social, or governance impacts or risks in their own bespoke ways, ESG tries to standardize that language so that we can compare and do peer comparisons regardless of jurisdiction, sector, geography, or size. I don't know if Kelsea or Geordie, you have anything you want to add to that?
Very good. Well done.
It's a big question.
It's a very big question indeed. And I actually find that relating to the question, somebody else is asking, okay, if I had to start literally like from zero, I have zero ESG data, how do I even get started on this? Like, are there any tips? And maybe that's a good question to ask to Kelsea, perhaps.
Sure. So what I did, step-by-step process, is I looked at the industry-specific framework from Sustainability Accounting Standards Board, SASB, and I itemized each one of the metrics within that framework. I compared it to GRI and TCFD, and then literally chunk by chunk, I went across the company and found a subject matter expert related to that piece. So whether it was labor relations and employee engagement, that was our human resources and human rights department. If it was environment, I worked with our facilities group. On governance pieces, I worked with our legal team, for example. And so assigning those responsibilities early on, and then I'd say the most critical piece in an early development of ESG is developing an ESG steering committee across the company. And so that's a a committee of senior leaders that can help to make decisions and drive change across the company. And so we didn't use our most senior leaders. We are really working with our vice presidents on that. And so they have the direct ear of the CEO, but they also manage several teams below them. And so they have a really wide reach across the company.
Yeah, I think that's a very good answer. And further to that, there is another question related. So I will just maybe stay on the point. There was a question from Susan who asked, how would you prepare all employees and colleagues for this sort of ESG data collection exercise? How do you hand in the data? Do you provide maybe learning resources, presentations, sort of how do you spread knowledge on this? Because I mean, I can imagine this is quite complicated, right, to communicate it externally to other stakeholders who are do not work in ESG, do not work in sustainability.
I provided team-specific documents where I provided the table of each individual indicator from both SASB and GRI, Global Reporting Initiative. And then under those, if the measure wasn't clear, number of employees is clear, but how do you manage or measure turnover so that it's comparable to other companies in the way that they're doing that? What does management actually mean? Is that VP level? Is it director level? Is it any people manager across the company? Those kinds of definitions I included in that document. And then I held team-specific meetings and talked through those pieces with each team.
I think that's a really cool strategy. And maybe one thing that I will add that may be a little bit provocative is I think you can overtrain people here. Not everybody needs to be an ESG expert. Everybody needs to be ESG aware as part of the data systems and processes. But you do not need your manager of supplier contracts to be an expert in the EU taxonomy. They need to know the right questions to ask to the right people at the right time. I think if we move away from this concept of ESG being a cost center, we have to be really thoughtful about when we're collecting data and how we're upskilling people. So, I really think about it as first taking a step back. What are the data points? Where does that data live? Who is the owner of that data? What level of knowledge do they need in order to do their task correctly and delivering it at sort of that precision rather than sort of expecting everybody in the firm to all of a sudden become an ESG nerd. That doesn't happen overnight.
Actually, it's really cool because Susan shared that she's alone preparing all of these things for the whole company, and it's really hard. And I think that's a point that can resonate with everyone. And actually, I have some questions from Geordie as well. So somebody is asking from an investor's perspective, what challenges exist around aggregating data?
So. Yeah, I think, certainly there are quite a lot of challenges around how people are aggregating data, what data they are aggregating. I think from our side, we'll see the number and then we'll go to the data. Like we have to understand exactly what data is being used and how this data is being aggregated. So, for example, much prefer to see the trend. Obviously, one data point is not hugely helpful, but the trend is more helpful for us. And then also understand exactly how they're collecting that data and what sort of sources they're using for us to really understand sort of the quality of that data and also if it's how it's being aggregated. For us, aggregating data, again, we use primary data mostly, so there's little aggregation for us. But however, obviously, when you look at some of our scope 3 emissions and the different sections within our company, then obviously, if that data, if from a cost side of things, if we use cost as the example here, you sort of aggregate sort of the cost of all your legal work into one function and one emission factor. That's not necessarily accurate, but I think it's. I think if you're using that way of calculation, it is obviously recognized, And so start there and then see, okay, look, what can we build on? Like, how can we improve this data? And can we sort of segregate it slightly? If it's office supplies or however, like, how can we split this up into like paper, into printer work and all sorts of electronics? So start with what is recognized, and if you can, and then once you've done that and more people are understanding of what you're doing, then it's more likely that data will start to become more apparent and appear. Because once you start the educational process and you start speaking to people on why you're doing it and what you're doing, they're like, okay, well, will this data point help? And more often than not, that data point will really help. So that comes with the process. But I think aggregation is, if it's an industry respected way of doing things, start with that. If you're looking at cost side of things and scope 3 emissions. But then for us, we want to really understand that raw data and how they've got to that data point.
Cool. Thanks a lot, Geordie. I think I actually noticed that we are almost about time, but if it's okay for you, I would just ask one more question to Ben, actually, which I think it's really relevant. So somebody's asking, how does AI play a role into this whole picture? And I think you might be the right person for this question.
Look, this is a gargantuan task. It is additive. All of a sudden we need to sort of upskill everyone to being ESG experts. And for a lot of organizations, it's just simply not cost effective. And so if we can figure out how to use technology to better collect, manage, analyze, and report on this data, we're more likely to be able to drive real value out of it. And I think that's really the thesis that I walked away from this conversation with today is, let's try and figure out how to make ESG data value additive. And the way to do that is to gather it efficiently. So taking advantage of cutting edge technologies like artificial intelligence are really critical to building out the right workflow and processes to do this work correctly.
That's great. Thank you so much. And I actually wanted to quickly share my screen one last time before we leave. So I will just do that real quick. I hope you can see my screen now. And because I actually wanted to mention that this is actually a topic we engage at Briink very deeply on. And it's really an exciting time because we will be releasing our new ESG policy screener anytime soon next week. And this will be a completely free tool. So you will be able to already use it and test it out at basically zero cost for you or your organization. And here you can see sort of a sneak peek of what the tool does. So this will be very useful to sort of screen governance policies from your organization, minimum safeguards. If you're familiar with the EU taxonomy, that's an essential part of the EU taxonomy alignment process. And in the future, it will also be expanded to more capabilities because we're building sort of a toolbox, AI-powered toolbox for sustainability teams. So if this is something that you're interested in, and here comes my little pitch, we are opening this up for early access users, and you can now request early access at the QR code that I'm sharing here. And we basically want to get as many people as possible to test it and give us our feedback. And as I mentioned before, it's a completely free tool, so you don't need to use any credit card or pay anything to use it. You can just start immediately. And that's what I wanted to say about this, actually. Cool. I see that there have been so many questions in the Q&A, but we are timed, so we won't be able to answer them. But what I will do, if your question is not anonymous, we will probably be able to pick up contact with you later or after this webinar when I share across the recording. So we can, basically maybe approach you to answer your specific questions, because I think there are many valuable questions still about auditing ESG data, quality assurance of ESG data. And I mean, it's such a broad topic that sort of branches out in many granular subtopics. And so it would be really important for you to maybe get our perspective on this. Yes, so I guess this is the end. And I wanted to thank everyone for joining us today. It has been a really great conversation, and especially big thank you to our speakers who were willing to engage with this super important and also complex topic. I'm just sharing your contact information one more time for our participants. Yes, and I wanted to thank you all. I don't know, do you have any last word or last, CTA that you wanted to share when it comes to ESG data collection?
Yeah, good luck.
Good luck. That's a good one. Okay, perfect. Thank you so much again, and bye, everyone.